Ladies and gentlemen, good day and welcome to Triveni Engineering Industries Limited Q2 and H1FY22 earnings conference call. As a reminder, all participant lines will be in listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Rishabh Barar from CDR India. Thank you, and over to you, sir.
Good day, everyone, and a warm welcome to all of you participating in the Triveni Engineering and Industries Limited's Q2 and H1FY22 earnings call. We have with us today on this call Mr. Tarun Sawhney, Vice Chairman and Managing Director, Mr. Suresh Taneja, Group CFO, Mr. Samir Sinha, CEO, Sugar Business Group, as well as other members of the senior management team. Before we begin, I would like to mention that some statements made in today's discussion may be forward-looking in nature, and the statement to this effect has been included in the invite which was sent to everybody earlier. I would also like to emphasize that while this call is open to all invitees, it may not be broadcasted or reproduced in any form or manner. We will start this call with opening remarks from the management, following an interactive question and answer session. I will now request Mr. Tarun Sawhney to open the call. Over to you, sir.
Thank you, Kevin. Good afternoon, ladies and gentlemen, and welcome to the Q2 fiscal 22 results earning call for Triveni Engineering and Industries Limited. The performance of the company in the half year ended 30th September has certainly been satisfactory. While the sugar segment has witnessed lower dispatches in the half year, including in Q2, the average realization price has improved quite significantly, and the firmness has really started in the month of August this year. The distillery segment has continued its strong performance, which has been driven by higher dispatches and higher realization prices. Performance of the engineering business has substantially improved in terms of profitability, despite marginally lower turnover, which has been primarily driven by the big improvement in the power transmission business. Revenues from operations for the half year stood at 22,066 crores, with a profit after tax of 184.77 crores, which is a growth of approximately 61%. The board of directors of the company approved the payment of an interim dividend of 125% for the financial year ending 31st of March 2022. I'd now like to cover the business segments of the company in a little more detail. The sugar business has, let me start with a summary, of course. The sugar business, the UP government has announced an increase in the cane price, or SAP, by 250 rupees per ton for the upcoming season. In view of the domestic and international factors, sugar prices have been ruling very firm since August of 21 this year. Sugar production for the upcoming season is anticipated as approximately 30.5 million tons, according to our estimates, and this is after the diversion towards ethanol. As far as the engineering businesses are concerned, the profitability increased substantially in view of the strong performance of the power transmission business, and the order booking for the combined engineering businesses stood at 1,700 crores. The revenues from operations for this quarter under question was 1,155 crores, with an EBITDA margin of 116 crores and a profit after tax of 92.47 crores. The decline in the net turnover by 9% in the current quarter and 12% in the half year is mainly due to lower sugar dispatches by 21 and 24% respectively. Having said that, the alcohol and power transmission business have achieved higher turnover in the current half year and quarter compared to the corresponding periods of the last fiscal year. The operating profit is in the quarter higher by 35%, as I mentioned, at 116 crores. The share of profit from the associate company is high due to accrual of significant exceptional income, and this point must be noted as well. The debt of the total company stood at 515.54 crores, 32% lower compared to 761.43 crores at the end of the previous corresponding quarter, September 30th, 2020. The 515 crores comprises of term loans of 3.64 crores, and all these loans are with interest subvention or at subsidized rates of interest. On a consolidated basis, the total debts of the company are 581 crores with term loans of 430 crores. The net cash position in the company is greater than 650 crores at this particular point in time. Looking at the finance costs, our average cost was 5.14%, very healthy, certainly below what our estimates were, and better than the previous corresponding quarter, certainly much better. Turning to the sugar business, for the quarter under review, we had 211,000 tons approximately of dispatches domestically, which was, as I mentioned, markedly lower than the 241,000 tons of dispatches in Q2 fiscal 21. Having said that, the domestic realization was 34,900 for the period under review, which was appreciably higher than 33,300 in the previous corresponding quarter. The turnover of the sugar business therefore was 16% lower due to the lower dispatches of 21%. The sugar inventory on the 30th of September 21 stood at 23.93 lakh quintals, which was valued at 29.2 rupees per kilo. There has been an appreciable and significant amount of heavy rainfall in the month of September and October, which has had an impact of delaying the start of the sugar factories in Uttar Pradesh. And it may possibly have an impact on the yield of the plant crop. Although at this particular point in time, with rains that happened as recently as this past weekend, it is uncertain to decipher what the impact is due. But there may be potentially, in the best case, only a marginal impact, but we will wait and see. The areas closest to Uttarakhand have been most impacted, and East UP itself has also been quite severely impacted by this unseasonal rainfall. At present, the prevailing sugar prices are 3,800 rupees per quintal for refined sugar and 36.75 for sulfitation sugar. Domestic sugar prices were subdued between May and July 21, and this was primarily due to the second phase of lockdown due to COVID-19. But as I had mentioned, sugar prices recovered appreciably from August 21 onwards, and with the start of the 21-22 season, we're expecting sugar prices to certainly be stable at refined prices in excess of 3,800, 3,600 rupees, and sulfitation prices in excess of 3,500 rupees. So a very stable environment is being forecast for pricing going forward by us. Our cogeneration operations achieved external sales of over 14 crores during the H1. There were no operations in Q2 fiscal 22, as this was our off-season. From an industry scenario perspective, I'd like to point out that sugar season 21-22, Uttar Pradesh is estimated to have an area of 23 lakh hectares, which is broadly in line with the previous year. Maharashtra's cane area is estimated, however, to increase by 11%, from 11.48 lakh hectares to 12.78 lakh hectares. The sugarcane area in Karnataka is also estimated to be marginally higher. The sugar production in Uttar Pradesh is expected to be 11.35 million tons pre-diversion, while in Maharashtra it will be substantially higher than Uttar Pradesh at 12.25 million tons. Karnataka is expected to be a shade under 5 million tons. For season 21-22, we have revised our estimate for the entire country for sugar production of 30.5 million tons, which is just a shade lower than the sugar production in the previous year. However, we have considered a much higher diversion of 3.4 million tons towards ethanol production versus an estimated diversion of 2.1 million tons of ethanol, of diversion towards ethanol in the previous sugar year. With an opening balance on the 1st of October 20 of 10.7 million tons and a production of 31 million tons, the closing balance is estimated to be 8.3 million tons, about 2.5 million tons lower. And I think this is one of the main factors which has resulted in the increase in the firmness in sugar prices. In my estimation, a very healthy level, a closing balance level, would be between 7 and 7.5 million tons of sugar. And that is what we need to hope for the future. Turning to ethanol, contracts for 350 crore litres have been executed until the 17th of October 2021. Out of the 367 crore litres finalized by the OMCs for the ethanol year, however, the total requirement was of 457 crore litres to meet the 10% target. I would like to mention very briefly over here that if we look at the quantity of sugar that is being diverted towards ethanol, our projections for the next year, with 2.1 million tons being diverted, 7.7% blending targets have been achieved across the country. Now, if we take 1.3 million tons of extra diversion, taking it to 3.4 million tons of diversion, in our estimates, that would equate to 2 percentage points increase, so at least a 9.7% blending target achievable at parity levels in the coming year. And this augurs very, very well, in my opinion, for the ethanol blending program across the country. Looking at the international scenario, as per industry reports, it's estimated the global deficit could be in the tune of 3.4 million tons in 2021, and this is due to primarily a lower Brazilian sugar crop. Brazil has had a very poor season. There have been talks of El Nino and a drought and frosts as well that have damaged the cane crop, and there is some evidence to show that this damage will not abate even in the next crushing season. As per the latest UNICA release, the cane processing for the Centre-South region in the current season is down over 7% from the same time last year. UNICA has also reported that 36 mills have also finished their crushing season, which is a lot worse than expected, practically. In Thailand, local cane prices and forecasts of ample rain suggested production recovery to 10 million tons from 7.7 million last year. And this is a very good recovery for Thailand, who will return to the international trade market, and will see Thai sugar competing with any Indian exports as well. Looking at pricing, as of yesterday, the number 5 contract for March concluded at $505.5, and the number 11 raw contract for March 22 was 90.7 cents per pound. This has vacillated. It has come down from the recent highs. The raw contract was as high as 20.7, 20.8 cents per pound. It has come down, but these are normal vacillations. It is expected that about 1.5 million tons of contracts have already been entered into for export of sugar from this year, primarily from Maharashtra and fractionally from Karnataka. Turning to our alcohol business, our sales for the quarter under review were substantially higher at 37,000 kiloliters versus 34,300 kiloliters in the previous corresponding quarter. Our average realization, of course, was also higher at 51.52 rupees per liter versus 44.76 in the previous corresponding quarter. Both the distilleries have operated at high efficiency. The production has increased by 12%. Volumes have grown by 8%. The net turnover for the quarter has also increased by 28%, as I've mentioned. During the quarter, the company produced 77% ethanol from B-heavy molasses, as compared to 26% in the last quarter. The company is well on track for its expansion plans, and I'll take a minute just to brief you on the commissioning status. The new distillery, with a capacity of 160 KLPD at Sugar Mill Millet Narayanpur, will be commissioned at the beginning of Q4 fiscal 22. The new grain-based distillery of 60 KLPD will be set up at Muzaffarnagar, and this too will be commissioned at the beginning of Q4 fiscal 22. The other expansions that are anticipated to take the total capacity of the company up to 660 KLPD will be completed in early Q1 of fiscal 23. The total cost, as I had mentioned in my previous call, for the entire expansion is anticipated at 350 crores. This includes the increase in material cost and pricing of raw materials that we've experienced over the last few months. So we're very well on track of meeting the targets that one had talked about the last time we had spoken on this call. Looking at the engineering business, the power transmission business has performed exceptionally well. We've had our highest ever quarterly revenue of 54.36 crores, which is a marked improvement, and commensurately a much higher PBT of 20.83 crores. Our order booking has also closed appreciably higher compared to the corresponding quarter last year and stands at 161, a shade over 161 crores. The higher profitability has been driven by volume, a favorable product mix, and cost control measures that have been implemented at the business unit. The water business also has had good results with a PBIT of 4.17 crores, and the order book has closed at 1,538 crores. These results include the operations of our wholly owned subsidiary executing the Mathura water project. There has been some small delays in the normalization of activities that I had talked about, and the last time we'd spoken about the water business having normal activities in the next coming quarters. We've certainly seen very positive trends towards that, with more contracts coming up for closure, and I think in this quarter under question, and certainly by next quarter, we should be back into a state of great normalcy, and it augurs very well for the business because I believe that we're very well positioned in a large number of upcoming tenders. Very briefly, if we look at the outlook of sugar, we expect that sugar prices will sustain, broadly speaking, at present levels, and I've given some indication of that, especially in the view of the increase in sugarcane price, SAP, that is payable by Triveni. The export program from the northern part of the country needs to be watched very carefully. My personal view is without an export subsidy, it is highly contingent on getting good ex-factory realizations for exported sugar, and it's a bit hit and miss, and so there's no level of certainty. I do believe that if there is any additional subsidy in any form that is offered, DBT or otherwise, we will have exports from North India. It is essential that we do export as a nation a minimum of 5 million tons to ensure that we have an excellent closing balance by the end of this coming sugar season. The ethanol production from the sugar mills is also intended to accelerate. I had briefly given an insight that we believe that 9.7+% is easily achievable by the industry. I think a big driving factor is going to be the increases in pricing of ethanol, which is expected to be announced in the very near future. And I think that is something that is an important signal and indicator for further capital expansion and for the industry to commit to beyond 10% ethanol blending levels. The Government of India has announced recent modifications to the monthly quota release mechanism and to incentivize diversion of sugar for ethanol production. And this is from October 21 onwards. However, that's only a small package. I think direct price increase is what the majority of industry is after, and certainly what we at Triveni are advocating. Looking briefly at our engineering businesses, the domestic economic recovery for fiscal 22 is expected to continue. Our strong sectors are steel, cement, petrochemicals, oil and gas, fertilizers, etc. These are all doing very well, and this bodes extremely well for the power transmission business. We've been focusing on business opportunities from defense and actively participating in several tenders, which we expect to see close out in Q3 and Q4. And the business is also equally focused on generating higher revenues from exports, which we anticipate in Q3 and Q4. And lastly, with respect to our water business, there are a large number of tenders which are in various stages of finalization, and we expect that to be complete during Q3 and Q4 of this fiscal year. So all of it really bodes well for a good closeout for the year, and I'd be very happy now to take some questions.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Sanjay Manyal from ICICI Direct. Please go ahead.
Hi, sir. Congratulations on good set of numbers. I have 2 questions. What would be the transfer pricing for the B-heavy molasses, and how do you value the inventory? What I understand, it is lower than last quarter, given the fact that it is off-season. Ideally, it should have been higher. So what exactly is the methodology for the sugar inventory valuation?
Yeah, I'll explain this question to you. The transfer price of B-heavy molasses is 850 rupees per quintal. And as regards to your second question, as of 30th of June, we had a certain valuation rate, and which was a blended rate between the sugar produced up to 31st March 21 and sugar produced in the first quarter. And obviously, the sugar produced in the first quarter, because of very high recovery, carries a very low cost of production. Now, what happens in Q2, as the sugar gets dispatched, so normally if the sugar which is produced up to 31st March 21, it gets dispatched, so therefore the quantum of high cost inventory reduces in our inventory, and therefore the valuation rate comes down.
Right, understood. Just one thing on the export front. At what price do you look to export if suppose government will not give any subsidy, and at what price you will look to export, and what quantities you think you would be able to, or you would require?
Well, let me take the first part of the question. I think at levels greater than 34 rupees per ex-factory, that would be the starting point for us to consider raw sugar exports, given where domestic prices are today. In terms of quantum, last year we managed to do just under 200,000 tons of sugar exports, and that was very easily possible, although some of that actually was slightly traded quantity. We have 7 sugar factories, and so there's ample opportunity during the sugar season to produce even more than that quantum of sugar for export. Not that we will, but you're asking a theoretical question, and so I'm offering a theoretical answer. There is the possibility of actually doing even more quantity than that, but it's all contingent on pricing.
Okay. And 34 you mentioned is X, means the X factory or?
Correct, X factory.
Okay. And just one last thing, if you can just elaborate your plans about liquor business. What I understand is revenue was somewhere around 7 crores. What exactly your bigger long-term plan about the liquor business?
Yeah, that's an excellent question. So, right now our foray as of December 20 is in country liquor only, IMIL, what is called IMIL. That is certainly projected to grow, where the alcoholic beverages vertical is a central part of our distillery and alcohol business, and we're looking at significantly higher levels as we move forward. This is really very much the start of the business. The volumes of IMIL was 3.69 lakh cases in Q2 fiscal 22. So it's, these are still small numbers, but they're growing at a very, very rapid pace on a month-on-month basis. As we move into the winter months, the consumption level goes up extremely high, and so we intend to participate in the growth in the market as well as to occupy a greater share in this particular market. At this particular point in time, we're running at near peak capacity levels of packaging, and where we have new bottling lines that are being installed as we speak.
Any number you would like to give, say, down line 4 or 5 years, what could be this business? What could be the size of this business?
We tend to stay away from forward-looking estimates.
Okay. Thank you. Thank you very much.
Thank you. The next question is from the line of Rakesh Majumdar from B&K Securities. Please go ahead.
Good afternoon, sir. How are you?
Very well, thank you. Good afternoon.
So I had, actually, I'll do a follow-up on the first question first, and then I'll go back to my question. You said that the net realizations in the factory would be 34 for exports to be viable. Are you referring to the Maharashtra mills or the UP mills here? Because for the UP mills, an additional 2 rupees in inward freight involvement, as I understand. So when you say 34, are you talking about the Maharashtra mills or the UP mills?
I am only talking about Triveni Group. I can't speak for any other sugar mills. So if we get 34 rupees ex-factory for Triveni, we will contemplate exporting sugar. Rates above 34 rupees per kilo ex-factory. My understanding is that Maharashtra has entered into export contracts well below 32 rupees for that 1.5 million tons that has already been committed. And certainly at levels of 32 rupees, I have been told that Maharashtra will, without subsidy, will enter into export contracts.
But isn't this a bit surprising because the domestic prices are so high and inventory position is already down sharply over last year? And considering the fact that we're expecting 30.5 million tons as against the earlier forecast of 31 million?
So, no, it's not surprising, frankly speaking, because it's all a matter of net realization and cost of funds taken into account. If you export today, you receive the money within 30 days, whereas if you hold the sugar, the average holding time is 7 months. So there is a delta in terms of holding cost that has to be considered. The second point, of course, is that the increase that you get in your monthly quotas from the central government, and that too has a financial impact as well. The third are the operating benefits of producing raw sugar. The raw sugar cost of production is significantly lower. You are able to crush at higher rates, and therefore there are operational efficiencies which when quantified up to that. So we are comparing what are prevailing of predicted sugar prices and looking at what would that price be for raw sugar, which would be a comparable, and that is 34 rupees.
Okay. So above 20 cents per pound, and if what you're saying pans out really over next year in terms of Brazil, and prices actually go up to, let's say, hypothetically 25 cents per pound, then India can actually export 7-8 million tons?
I don't see why not. I think at prices closer to 21 cents, which would be high for the market, because the market's only had a recent high of about 20.8. But at those levels, and provided we have a favorable exchange rate, which is a very important element in this, because the exchange rate, which is dollar rupee, which is at 75 plus now, was for a period of time in the very recent past 73.5, and that of course is a negative factor as far as exports are concerned. The realizations fall. So these are the factors that one will have to look at.
Right, but around 20 is comfortable for 4 million tons, you think? If it's 20 and dollar is 75?
Around 20, it's dependent on exchange rates, but yes, I think we will certainly see higher exports. You have to consider the fact that at levels of 19 cents, there have been no new export contracts that have been entered into in the last few weeks. So if we come back above 20 cents, there will be opportunistic placement that will certainly happen, and we will be able to go from 1.5 tons to potentially 3.5, maybe 4 million tons. But for us to reach 5 to 6 million tons, which is what I think is absolutely necessary, we either need the world market to increase substantially, which is a bit of a challenge given where the prices have been in the last 30 odd days, or we need some kind of government intervention.
Right. And my second question was,
I just want to add that there is sufficient time for that intervention. We haven't even really seen the start of the crushing season in North India, so there's plenty of time for that decision to be taken by GOI.
Okay. Got it. And my second question was, why is the government not announced an MSP when they announced the cane price hike? I mean, it has really been, nearly 1.5 months since the cane price hike was announced, or a month, and we still see no announcement of a MSP hike, whereas the cost of production for everyone has gone up between 2 to 2.5 rupees per kg, right? So, I mean, right now the prices are good, but investors will be more happy if there is the base set in so that the downside is also known by the market.
Well, investors will be happy and operators like us will be happy as well. You know, we run sugar factories. We will have greater certainty and peace of mind as well. I don't have an answer to that. This is a decision that is based at Krishi Bhavan. The Ministry of Food makes that decision as well, and in their wisdom, they've chosen not to increase it. Having said that, the industry associations and we too at Triveni are pushing forward our perspective that it is vital that in a landscape where cane prices, both FRP and SAP, where both of them have risen, it is important to raise the MSP as well. There is an off chance that it will happen this year.
Okay. And ethanol prices are linked to what? SAP or FRP? So if the FRP has been hiked by 5 rupees, we can expect a similar hike in the ethanol, or how should we look at that?
So ethanol pricing, there's no publicly given formula, but it is a complex set of issues. It is, what I can share with you is it is certainly not connected to crude. That the ministry has been amply clear on. There are many constituent elements in arriving at that. One of them happens to be the price of cane. There are other elements as well. I think the government will also look at prevailing sugar prices in order to look at the ethanol price, because there is an opportunity cost as well. There are two elements. One is the cost of cane. The second is the opportunity cost of making sugar or diverting juice and syrup to ethanol. And those are important things for the government to consider in establishing the ethanol prices, the various ethanol prices.
Okay, and what would the expectation be for the ethanol?
So sorry to interrupt, but for any follow-up, may we request you to rejoin the queue, please?
I'll just answer that question. It's impossible for one to say, but I do expect that during the course of November we will get the pricing. So it's not too long in the future. You will know in the next 30 odd days.
Thank you. The next question is from the line of Karan Agarwal from Tusk Investment. Please go ahead.
Hello, hi. Thank you, sir, for taking my question. Could you please highlight to us the reasons why did we dispatch lower sugar this quarter?
Yes, we've dispatched lower sugars this quarter because we are subject to the quota mechanism, which is by the Government of India. The Government of India ascribes a quota per sugar factory. We have 7 sugar factories, and they ascribe this quota on a monthly basis, and it is based on the stocks that are in hand and the anticipated consumption levels. Our quotas this year compared to last year are different because in the last year Maharashtra's production was much lower, and so the UP millers, to meet the consumption across the country, got a higher quota. In this year, the sugar for production in Maharashtra was higher, and therefore the total amount of sugar proportionately given to each and every factory was commensurately a little bit lower, and that is the primary reason why our quotas were slightly lower compared to the previous year.
Thank you, sir. That answers my question. And I have one more question, which is that the current inventory that we have as of date, how many months do you think we'll take to liquidate this inventory?
We anticipate that we will liquidate this inventory by January.
And previous year it was when did you liquidate it back?
So previous year we went up to end of January as well, early February.
Okay, so we see a significant improvement here. Thank you. That answers the question. I'll join back.
Thank you. The next question is from the line of Ambar Taneja from Geometric Capital. Please go ahead.
Hi, my question is, you just mentioned that you'll be looking at exports for at a net X mill price of about $34. So, I mean, assuming some linkage between NY11 and your X factory, where would you say that the March contract price has to rise in order for you to get offers for a 34 rupee X mill kind of number? And number two, industry-wide, this year we have seen ethanol blending use 3.4 million tons of sugar as per the latest estimates. What would you hazard a guess for the next year, next October, if we were having a chat? How much do you think we could achieve? Thanks a lot.
Sure. Okay. To answer your first question, there are two elements. Firstly, I'm assuming that the rupee dollar would be 75 plus. Okay, not below 75. And if we saw the number 11 March contract come closer to 20.3, 20.4 cents, I think that we could easily get offers in this kind of range. And provided the rupee is about 75 to 75 and a half. At that level, we could start to see some interest. There are two reasons. The first is that if we reach 20.3, 20.4 cents, it is a significant departure from the 19 cents that has prevailed through the month of October. And so therefore, sugar would have broken out into a new band. And then there is, of course, sufficient volatility that exists in the market. And it will create more appetite for Indian sugar. So I think those two are very important elements in getting this 24 rupee realization X factory. Now, turning towards your question of the advanced estimate of 3.4 million tons of sugar being diverted towards ethanol production, for the subsequent year, it's a big question mark. And the reason why it's a big question mark is it really depends on what the constituent is of the 3.4 million tons. How much of it remains as B-heavy and how much of it is juice. For us to achieve higher diversion rates, we need to have a much larger juice syrup program, and therefore we need juice pricing to go up. And so it's really dependent on the pricing that we see, not just in the month of November, but then of course in the following year as well. Why the pricing in November is important is because any company across the country that is looking at setting up a distillery will look at this year's pricing as a benchmark for the future. And that is absolutely vital and important. I don't see sugarcane production coming down. Okay. Frankly speaking, the little bit of disease, etc., will be replaced by other varieties. And that is why I've not even addressed it in my opening remarks. For us, I mean, yes, there are isolated incidents of pest and disease across the country. But with strong varietal replacement programs, you are able to mitigate that risk. Now that you have a good quantity of cane forecast, not just this year, next year, and beyond, the real question is how much gets diverted towards ethanol. That function is purely based on pricing. And so my hope would be that we would achieve much higher levels of closer to 4.2 million tons of diversion in the following year. But that is only possible if there is fresh investment in capacity that happens over the next few months and we have better pricing.
Okay, fair enough. Okay, thanks a lot.
Thank you. A reminder to the participants, anyone who wishes to ask a question may press star and 1 at this time. The next question is from the line of Sanjeev Damani from SKD Consulting. Please go ahead.
Good afternoon, sir, and congratulations for very good set of numbers. And thanks for giving me opportunity. My first question is regarding my understanding about raw, finished and refined sugar. If you can kindly explain. You did mention something, but I could not understand much about it. So can you kindly tell me that?
Can you rephrase your question?
Sir, I wanted to understand what can be termed as raw sugar, then finished sugar and refined sugar, and what are the costing differences in that process?
Very significant differences. Raw sugar is not fit for human consumption. It has ACUMSA levels, color levels higher than 600 ACUMSA. You have plantation white sugar that's available across India. This is crystalline sugar, white crystal sugar that is typically sold, majority of sugar produced, that has ACUMSA values up to 150 ACUMSA, let's say 50 ACUMSA to 150 ACUMSA. And then you have refined sugar, which has ACUMSA levels sub 45 ACUMSA. That is what is typically traded globally and considered as white sugar. As I mentioned to you, you have international benchmarks for raw sugar because raw sugar is not traded domestically. At present, raw sugar is trading internationally at 19.7 cents and refined crystal sugar is trading at $505 per metric ton. The price of plantation white sugar varies across the country depending on where you are. In Uttar Pradesh, it is typically ₹1.50 to ₹2 per kilo higher. At present, the prevailing prices in western Uttar Pradesh are approximately 36.75 rupees per kilo.
Sir, I wanted to understand the costing part at factory level. When we export raw sugar, do we incur less cost to export raw sugar?
No, we don't. The costing ex-factory level, we are not exporting raw sugar right now. At this point in time, we're not exporting raw sugar.
Okay, sir. And because I presume this way that when you export raw sugar, you are not able to extract molasses. Am I correct or I'm wrong about it?
You also get molasses.
We get molasses. Even when we export raw sugar, we get molasses at our place. Thank you, sir.
Yes, thank you.
Thank you.
Thank you. The next question is from the line of Karan Agarwal from Tusk Investment. Please go ahead.
Thank you, sir, for taking another question from my side. So, if I'm not wrong, you said that the sugar prices are going to stabilize around 37 per kg. Is that correct?
So what I had said was that our anticipation for the following year is 36 rupees for refined sugar and 35 rupees for plantation white sugar.
Okay, sir.
For the average for next year.
Average for the next year, yeah. So in the following few months, we can expect that the domestic prices of white sugar to gradually come down because the new crushing season is underway. Is my understanding correct?
Yes, you can say from the level that we're at now, which is a peak. And frankly speaking, it's the wrong point in comparison because we have just finished with Dussehra. We've got Diwali in the biggest holiday season that is coming up, and prices tend to inflate coming up to Diwali, and then they peter down and come to a normal rate, which is still a very respectable increase from where the prices were in early August of this year.
Yes, sir. So 35 is the average we can assume going forward next year.
For plantation white and 36 for refined.
36 for refined. Got it. Thank you, sir.
Almost 50% of Triveni sugar is refined.
Okay.
45% to be precise.
Okay. Thank you, sir. Thank you.
Thank you. The next question is from the line of Anupam Goswami from B&K Securities. Please go ahead.
Yeah. Hi. Good afternoon, sir. My first question is from the follow-up of earlier question. So you mentioned that for the country to increase its blending program, juice program has to incentivize. According to my understanding, the margin in the juice segment is a little lower than B-heavy program. So does it mean that the juice prices has to go up in order, or at least equivalent to B-heavy prices or the margin level, where then we can see a higher blending and higher, a meet of the requirement of the higher blending? Sorry.
You're absolutely correct.
Okay. So right now it is not very profitable for a mill to go for the higher juice instead of B heavy, right? We are doing it just to lower our sugar inventory.
At this particular point, the margin from B heavy is higher than that of juice. You're absolutely correct in that understanding.
But now to set up a juice unit, what is the thought process? What is the motive in that? Just to decrease the sugar capacity, sugar stock?
It's a commercial decision. It's based on a return. It's based on a project return. Now, whether you decide to push juice through it or push B heavy through it, it's the same technology and the same process. You don't have a different plant that processes C molasses and B heavy molasses. It's the same technology across the board. It's just the size differs. So you always have the possibility of buying molasses from the open market as well.
Okay, sir. So my next question on the Triveni distillery, we have seen the EBIT margins going up till 24%, even though we have about 70-75% blending towards diversion towards B. When can we see a margin which is more about like the industry standard, or how the industry leaders are doing about 40-45% to that level? And what is our cost of production in this distillery segment, the cost of production of ethanol precisely?
You see, if you look at this question, the output price is fixed. It's dependent on the product mix. We do about 77 to 80% of B heavy. Therefore, the output pricing is well known. On the input pricing are the pricing of molasses, which is dependent on the transfer pricing policy that various peers may be following, which may be different from ours, as well as the conversion cost. Our conversion cost is a little under 9 rupees on a blended basis, and that would be, I would say, on par with everybody else, one of the most efficient operators for achieving a ZLD kind of environment.
In a nutshell, it is based on your transfer price. So, there is no benchmark per se, because you can change your transfer price to reflect a higher profitability in one business at the cost of another business.
Right. I understand. If the transfer price goes up, then its sugar division will have a higher profit. Okay. So my next question is, if the export prices go up, do we see domestic prices also firming at the same time, and if government will come in between and put a cap on the domestic prices?
I don't see the government putting a cap on domestic prices in any time in the near future. I do not believe that if there is a marginal increase in international sugar pricing, that it will have a commensurate positive impact in India. If we are able to maintain the prices that have elevated because of the holiday season, that would be a good achievement.
Okay. Thank you, sir. I'll join back in the queue.
Thank you. A reminder to the participants, anyone who wishes to ask a question may press star and 1 at this time. The next question is from the line of Sanjay Manyal from ICICI Direct. Please go ahead.
Yeah, just follow-up question. Sir, do you have liters of ethanol in Q3? What I understand your...
I'm sorry, you broke up. Could you repeat the question, please?
My question is, do you have sufficient molasses by the end of September to produce 3 crore?
To produce 3 crore, why did you look at that number? Is it for the quarter? Because we have sufficient old molasses which will last us until November, and in November our units are starting and there will be new molasses coming into play.
Seems like we lost the connection for the current participant. As there are no further questions, I now hand the conference over to the management for closing comments.
Ladies and gentlemen, thank you very much for joining us for the Q2 fiscal 22 results for Triveni Engineering and Industries Limited. My hope is that when we speak next for the Q3 results, we will have had substantial developments within the industry. There will be a brand new ethanol policy, which is something that is eagerly anticipated. We will know the result of the rains on the recoveries as well as projected crushes for Uttar Pradesh. They will be in a better position to talk about anticipated production levels across the board. And those are important points. And plus, we will see a return to normalcy, hopefully, across our engineering businesses after the COVID lockdowns, which have abated. Thank you very much for joining today, and I look forward to speaking to you in approximately 3 months.
Thank you. Ladies and gentlemen, on behalf of Triveni Engineering and Industries Limited, that concludes this conference. We thank you all for joining us, and you may now disconnect your lines.